Bill, you've had some time to process all of that. What do you make of it?
I think it was pretty logical what happened. Basically, the Fed is saying that, one, uncertainty has gone up a lot. We're not really sure how long the banking system stress is going to last and how severe it's going to be. Number two, that stress is going to restrain the economy, and that substitutes a little bit for rate hikes. So we're not going to have to do as much as we thought we were going to have to do earlier. But I think the real key is something that Mike McKee talked about. Uncertainty has gone up. Uncertainty has gone up a lot. And I think it's sort of interesting that markets are not really fully focused on that, because the risk of a hard landing is higher now, because the Fed isn't going to really know what's the appropriate policy to do until they get a lot more information. And it's going to take time for that information to be received. And it's not going to be very easy to assess how are these banking woes going to affect credit conditions, and how much is that going to affect economic growth. So I think that we're actually in a worse place today than we were a few weeks ago, because there's two forces. One force is keeping inflation high. Another force is slowing the economy down. And we don't know which one is going to dominate or for how long. So I think the risk of a hard landing has definitely gone up.
Bill, the easy way to dismiss any conversation around the Fed is just to say they're data dependent. I hear that so much. They're going to be data dependent. But Bill, at this point, I'm wondering, what data are they dependent on for the next decision?
Well, I think the problem is that the data on the effects of credit tightening on the economy take a while to actually be realized. We have two sort of open questions about the banking system. Number one, how broad is it going to be? How many banks are going to be affected? Number two, how much are banks that are affected actually going to tighten their credit standards? The problem is not a credit problem. The problem was actually banks taking on too much interest rate risk. So it's not obvious to me that tightening credit standards is really the logical response. And number three, how long is this going to go on? So I think that there's a lot of uncertainty here about how much of a braking effect the banking system woes are going to be on the economy. The fact that the Fed basically has one more rate hike and then keeps rates high throughout the year suggests that at this point, they don't think that this is going to exert a lot of downward momentum on the economy. What's interesting today is the market reaction to the Fed's press conference and the statement and the summary of economic projections was to be ever so slightly surprised by the rate hike, because it wasn't fully priced in. But actually, it's pricing in more rate reduction in the rest of 2023 and into 24 than they were earlier. And I think that was a little bit surprising, frankly, given the fact that Powell was very clear. We don't expect to cut rates in 2023.
Does that open up a question about the credibility of the Fed?
I think it opens up a question that people are just very uncertain about what the banking system will mean for economic activity, and then how does that actually translate to the Fed. I think people are worried about the downside risk from the banking sector.
Steve Chiavarone of Federated, I keep going back to this because I think it's a really salient point. This meeting marks the passing of the torch from inflation and duration risks, he wrote, to recession and credit risks. Arguably, what we have seen is not a credit crunch. However, often liquidity crunches can lead to credit crunches, as we've seen in the past. Bill, do you agree that this really is a tipping point as represented to some of the changes in the statement?
I think it really depends on how broad and how long. I mean, we've had other examples where there have been all sorts of market turbulence and no recession resulted. The most obvious example of that was the 1987 stock market crash, where people were talking about making analogies back to the Great Depression, and the economy didn't go into recession at all. So I think the real issue here is how many banks are affected and how strongly do they react. When I look at the U.S. banking system today, I see only a handful of banks that have actually been affected, and they only account for a few percentage points of total banking assets. So I personally think that if this thing is stabilized right here, the effects on the real economy are going to be pretty modest.
So to be clear then, Bill, that's an important point, because we're only 2 weeks into this. If it doesn't spill over and carry on bleeding, are we going to go back to what we were talking about 2-3 weeks ago in another 2 weeks?
We very well can. I mean, I don't think we'll have the clarity in 2 weeks, but 6 weeks from now, the next FOMC meeting, maybe we're back in the situation where, the banks that were under pressure have either remedied themselves or been acquired, and the rest of the banking system is fine, and the economy is still too strong, and the labor market is still too tight, and inflation is still too high. I mean, the reality is the Fed actually hasn't accomplished much yet in terms of generating more slack in the labor market or actually bringing services inflation down. And that's important to recognize.
So when the Fed chair says we're not thinking about cutting interest rates this year, I guess you're saying we should really take him seriously because you don't think that's going to happen at all.
Well, there's a wide band around that possible outcome. But I think what he's saying is that job number one for the Fed is to get inflation down to 2%. And they think that's going to be a long, drawn-out process, not something that's going to happen very, very quickly. I thought it was interesting in the summary of economic projections, if you look at their forecast, the forecast virtually unchanged from the December meeting. So essentially what they did was, economy is stronger than we thought, inflation is higher than we thought. Oh, but we have had some banking system woes. What should we do to our forecast? Well, let's leave it basically unchanged. Because that's and they're doing that because they just don't know which of those two forces predominates.
John mentioned that you could drive a truck through some of the economic projections if you take a look at the dots and how far apart the highest and the lowest are. I was really struck by 2025 dots and just the range of estimates from 5.6% to 2.5%. I'm wondering if you've ever seen anything like this before, where there is so little of a compass directing all Fed members, but even if they're on the same page right now.
I think that they're on the same page in terms of if you told them what the economic forecast was, they would write down interest rate path that was pretty similar. I think what they probably disagree on is how is the economy actually going to evolve? How quickly is inflation going to come down? What's going to happen to economic growth? Are we going to have a hard landing or a soft landing? And so there's probably just a lot of uncertainty about how the actual economy is going to evolve. And that uncertainty about the economic forecast, I think, has gone up. So the modal forecast contained in the summary of economic projections has not changed very much at all. But the distribution, the probability distribution, has widened out dramatically, in part because of the banking woes.
Final question, Bill. Next decision is May 3rd. Is that enough time to get the incoming information you think they need?
We'll see. I mean, I think it's going to be either the banking system stabilizes pretty quickly in the next few weeks, or we just have, creeping problems. The problem that in the banking system is when the weakest bank gets into difficulty, that raises the stress on everybody else because everyone else gets more skittish.
Yep.
All the people that are using the banks are much more skittish today than they were before Silicon Valley Bank failed. And so it doesn't take as much bad news today to generate the same response as a couple of weeks ago.